Okay, so we now begin 2026, and I wish all of you a happy new year. Today, I wanted to start our new year by reviewing every asset class and get a sense of where each asset class will head in 2026. Now, as I say all the time, it is impossible to speculate how the prices of each asset class will move in the future, but what we can do is to get a sense of important levers which will impact each of the asset class and focus on those levers throughout the year to predict how the prices of each asset class will move. Now, as you may all know, the primary asset class I've been covering is mostly stocks. And when I predict how the stocks will move, I generally focus on the macro factors such as fiscal policies, monetary policies, and overarching regulations. But today, I'll go through each asset class, including stocks, bonds, gold, and cryptos. Okay, let's get to it. Okay, so first, we need to review the important things to watch in 2026. I mentioned in my previous video titled 5 Things to Watch in the Market in 2026 that the 5 things to watch are: number 1, the new Fed chair; number 2, Elon Musk; number 3, AI stock IPOs; and number 4, labor market and inflation; and number 5, bank reserves, repo, and reverse repo. Now, those 5 factors will generally impact all the asset classes in general, but what would be worth doing is to see how each factor will impact each asset class, and on top of those 5, what other factors there will be which will impact each of the asset classes. Now, just a caveat, don't take my words for granted, as this is just my personal guidance on how to manage my portfolio. As always, just consider it a playbook to educate ourselves on how we view the world and capital markets in 2026. Okay, let's begin with stocks. Okay, so on stocks, what would be important is to distinguish stocks into 4 groups. Those are A, Mag 7 stocks; B, non-Mag 7 AI stocks such as Oracle and Palantir, AMD, Broadcom, or Micron; and C, non-AI stocks with high earnings and high valuation such as Costco and AAA; and D, non-AI stocks with low valuation such as pharma stocks like BMS and Pfizer. Now, there are plenty of stocks out there which don't fall into those categories, but those are the stocks which I would follow to read the overall macro. Okay, so let's go through each of the key factors. First, let's look at the stocks from Fed's perspective. The 2 things which will impact the stocks the most are number 1, and number 4 from the list, which are the new Fed chair and labor market and inflation data. Now, depending on who the new Fed chair is, the interest rate trajectory will change dramatically. And if the new Fed chair indicates that he or she will aggressively lower the interest rate, it'll be beneficial for all stocks. Now here, my prediction is this: if the sentiment of the overall Fed governors and the new Fed chair indicates that they'll lower the interest rate by 100 basis points or more in 2026, the overall stock market will rally. The reason is, based on the dot plot estimates issued by the Fed in December, the Fed indicated that they'll lower the interest rate by only 1 to 2 times in 2026. The market is already pricing in the potential rate cuts, and some market participants are estimating that there will be 3 to 4 rate cuts, i.e. 75 to 100 basis point rate cut in 2026. Now, those people are very optimistic market participants, so based on the current average sentiment, around 100 basis point cut in interest rate will be more than enough to rally the entire stock market. Now, what would be needed for the Fed to lower the interest rate that much? The only 2 factors which will matter are, number 1, the labor market, and number 2, the inflation data. Now, in 2025, the Fed was going back and forth with their interpretation on those 2 data. The most ideal scenario would be for the labor market to show more weakness, i.e., ideally an unemployment rate of near 5% or higher, and an year-over-year CPI of 2.5% and lower, which shows a gradual cooling down trajectory. Now, the issue here is that the Treasury and the Fed are both showing some reservations on the near-term inflation. The most dovish Fed governor at the current moment is Stephen Miron, who has been consistently arguing for almost 150 basis point rate cut in the near term. But even Miron recently somewhat expressed his concerns on inflation. In a recent interview, Miron said he's looking for about 150 basis point cut in 2026. However, that his outlook is grounded in his reading that underlying inflation may be around 2.3%, which is close to the Fed's target, justifying easier policy. Now, what this means is that he's not advocating for a reckless cut like he did before, but he's now wary of the inflation, and he'll only support a really big cut, assuming that the inflation is generally stabilized at around low 2% target. Now, given Trump, Bessent, and Miron are very close, this also shows the Treasury stance on the future interest rate trajectory. As I've been saying all the time, we will only be able to tell how the tariff is impacting inflation at around second quarter of 2026, so we still need to see how things span out. Now, on Elon Musk's SpaceX IPO and other key AI stock IPOs, such as Anthropic and OpenAI, if any of those IPOs get delayed or does not attract enough demand, it'll be catastrophic for A and B stocks, but will also negatively impact C stocks as well. As I say all the time, the current market is a thematic market driven by AI stocks, and most other stocks are being dragged by a few AI stocks, including the Mag 7s. Therefore, if any of those key large cap stocks, which has valuations of trillions of dollars, fail, it'll bring a very negative impact to the overall capital markets, but more so for stocks A and B, and somewhat to stocks C as well. Okay, so to summarize, this is my take. If these conditions are met, we should invest heavily into stocks A and B. Number one, the new Fed chair, who will most likely be named sometime in April or May, indicates that he'll cut the rates by more than 100 basis points in 2026. Number two, labor market remains shaky with unemployment rate getting close to 5% and CPI cools down to below 2.5%. Number three, large cap IPOs like SpaceX, Anthropic, and OpenAI progresses as scheduled and successfully attracts demand. Now, the least important factor among those, in my view, is the labor market. So even if we see some counterintuitive data coming out in the labor market, we can still invest and hold our investments in A stocks, but may want to reassess our positions in B stocks. Now, if situations are reverse of what I just said, we may want to skew our positions towards D stocks and some C stocks as well. C and D stocks are traditionally more defensive stocks, but depending on valuation level, we may want to avoid C stocks as well. As I say all the time, PE ratio of over 20 to 25 times for companies with less growth can also be destroyed in value, so we need to be careful at all times. Okay, so that wraps up stocks. Let's move on to bonds. Okay, so bonds is simple. If we anticipate the Fed to cut the rates a lot, i.e. more than 100 basis points, bonds will most likely rally. But if the market expects the Fed to cut the rates by less than 50 basis points, bonds will most likely go down. However, there are two things we need to monitor. Number one, we need to distinguish the long-term bonds with short-term bonds. And number two, we need to distinguish the Federal Reserve policy rate with the bond's market rate. In recent years, given the drastic movement in the Fed's policy rate, while the short-term bonds, which are a lot more connected with the Fed's policy rate, moved in accordance with the Fed's policies, the long-term bonds showed a lot of counterintuitive movements. The reason this happened is because of the market's expectation on inflation. In other words, the more the market disagrees with the Fed's actions, the long-term bonds will move in different directions with the Fed's policy rate. To elaborate, the Fed may decrease the policy rate, which would mean that the long-term bond price should move up, as the interest rate and the bond price has an inverse relationship. However, in recent years, there are a lot of situations where the long-term bond price didn't move or even moved in opposite directions versus the Fed policies. This is really because the market believes that in the mid to long term, the Fed will have to revoke or reverse their decisions towards a different direction because the inflation will spike up, unlike what the Fed expected. If the inflation goes back up to near 3% level, the Fed will inevitably have to either stop the rate cut or even increase the rate to stop the inflation from going higher. And this is what the long-term bond investors are counting on. So basically, on the recent trajectory, this is what we need to monitor. If number one, the Fed decreases the interest rate significantly, and number two, if the inflation rate also cools down along with the rate cut, both short-term and long-term bonds can be good investments. However, if the Fed cuts the rates, but the inflation doesn't cool down, we may want to stay away from long-term bonds. Okay, let's move to gold. Okay, so in 2026, in my view, there are two things which will move the gold price. Number one, M2 money supply, and number two, geopolitical tensions. So M2 money supply is simple. If the Fed aggressively decreases the interest rate, i.e. 100 basis points or more, the gold price will most likely continue to go up. Now, there's a small chance of this happening, but if the Fed conducts a QE, which they haven't for the past 3 years, the gold price will most likely move up. On top of that, the more important factor which will impact the gold price is geopolitical tensions between the US and other countries. If the US continues to push the tariff to other countries, including ally countries as well, and if the court ruling on the tariff somehow results in a pro-tariff decision, other countries will accelerate their movement of shifting away from the US dollar and using gold as their main reserves rather than the US dollar. If this happens, the gold price will inevitably continue to go up as there will be additional demand from all the treasuries of the world which will continue to buy gold. We will need to see how things pan out, but gold will continue to rally as long as geopolitical tensions continue. Okay, finally, let's move to cryptos. Now, I rarely talk about cryptos, and the only video which I talked about it is in a video which I uploaded almost a year ago titled "Watch This Before Trading Any Cryptos" video. The reason I don't talk about it is because it is almost impossible to predict the price of cryptos. The levers and the drivers of crypto prices change all the time, and sometimes the drivers are things like wars, which is almost impossible to predict. However, I just wanted to share a general theory which I count on when I buy cryptos. Okay, so in my mind, one-off factors like wars aside, crypto prices are generally driven by, number one, M2 money supply, and number two, regulations. So money supply is simple. It just comes down to my basic theory of interest rate and the Federal Reserve balance sheet. If the interest rate goes low and the Federal Reserve balance sheet increases, crypto prices will generally increase. If things are the opposite, it will generally decrease. However, one thing to note is that even if the M2 money supply is abundant and increasing very fast, not all crypto prices will increase. To elaborate, let's say M2 money supply is gradually increasing every day. Between stocks and cryptos, I like to believe that there are certain orders which the price movement is impacted. If the M2 money supply increases to this much, the first beneficiary will be the Mag 7 stocks. Now, if the M2 money supply increases even more, the next beneficiary will be the other AI stocks. But on top of that, in recent markets, Bitcoin and Ethereum seem to get positive impact. If the M2 money supply increases even more from there, other large cap stocks with high growth will generally go up, but also other layer 1 cryptos like Solana, Cardano can also be beneficiaries. If the money supply increases even further, other stocks which have lower earnings with low valuation will get benefits, but also layer 2 cryptos like Matic will also become the beneficiaries. Now, if the M2 money supply increases even further from there, like what happened in 2020, meme stocks and meme cryptos like Pepe and Shiba Inu will also show positive price movements. Now in 2026, I think M2 money supply will increase to some extent given interest rate will go down. However, it is very difficult to imagine the money supply to increase to the extent where layer 2 and beyond cryptos will become the beneficiaries. Now, obviously, if we have a one-off event like COVID one more time, things will completely change. But unless that happens, there are a lot of hurdles to overcome in 2026, like the inflation. Therefore, if you'd like to invest in crypto, I would generally only focus on Bitcoin, Ethereum, and other major layer 1 cryptos, and just invest a small portion with a long-term target, rather than trying to gain short-term returns. Now, one thing I'll add is that recent crypto market has shown that it is quite closely connected with Trump. Trump has generally been friendly towards the crypto market, including his stablecoin agenda. So if Trump's approval rating goes up in 2026, it'll also be beneficial for the crypto market. Okay, so with that, I covered most of the asset classes and what to watch for in 2026. I hope this video gave you a good general guidance on what to watch in 2026, and I hope all of you guys get successful in investing this year. Again, Happy New Year to all of you guys, and I'll be back with more videos very soon.